Now, let's get this party started. Today is a new day, which also means a whole new lineup of equally strong speakers from the region and strong topics to explore. So without further ado, I'm very excited to kickstart the first panel session for day 2, which is, Finclusion-Tech, empowering a global digital economy. For that, I'd like to invite Joshua Kwa, who is the principal of Integra Partners, as the moderator who will be moderating this session. And joining him on stage is Sheyantha Abeykoon, Group CEO of Boost, Wilson Bay, President of FinTech Association of Malaysia and co-founder of PolicyStreet, and Han Liu, co-founder and director of Jernexu. Now, ladies and gentlemen, payments have come a very long way in the past decade. From cash to card-centric payment systems and decentralized finance, we have now moved to digital and mobile-centric solutions. Now, let's hear what our experts have to say on their modern experience in financial services. Now, over to you, Joshua.
Thank you. Hope everyone had a good breakfast and gotten your coffee. Good morning, everyone. My name is Joshua. I'm principal at Integra Partners. We are an early-stage FinTech, InsurTech, and digital health investor focusing on Southeast Asia and South Asia's financial inclusion and healthcare inclusion. I'm excited to be here today to discuss a very important topic on Finclusion, how FinTech can empower financial inclusion in the region. And joining us here today, we have 3 very distinguished panelists who are actually working at the forefront of this problem. We have Sheyantha, Group CEO of Boost. We have Wilson Bay, the president of the FinTech Association of Malaysia and the co-founder of PolicyStreet, and Han Liu, co-founder and director of Jernexu. Now let's start with a quick round of introductions, beginning with Sheyantha.
Thank you so much, and it's great to be here at Wild Digital after a hiatus of a couple of years. So my name is Sheyantha. I run a FinTech called Boost. Boost is a company that started about 5 years ago here in Malaysia. We have presence in the region as well, in countries like Indonesia. Primarily started our journey as a payment service provider, but we have evolved our model into getting into a whole host of other areas like lending, InsurTech, and so forth, and we'll be happy to share some of our experiences in this region. Recently as well, we were one of the successful applicants for the digital bank license here in Malaysia. So as a company, we are at a very interesting juncture of our evolution and looking forward to the next couple of years ahead.
Hi, good morning, everyone. My name is Wilson, and I'm a co-founder of PolicyStreet. PolicyStreet is an InsurTech company, and we are a digital reinsurer and also an offshore general insurer. Here in Malaysia, we underwrite and develop inclusive, micro, innovative insurance products for emerging affluence, gig and digital economy. And we also provide financial advisory services for the masses as well. And on a separate note, I also wear the hat as the president of the FinTech Association of Malaysia. We are the national platform to advance Malaysia to be a leading regional hub of FinTech in this region. Thank you.
Morning, everyone. Hope everyone's well. I'm Han. I'm the co-founder and director of Jernexu. Jernexu is a FinTech company that's been headquartered in Malaysia over the last 11 years now. We are best known in Malaysia as the owners and operators of ringgitplus.com. Now, ringgitplus.com started as an online financial aggregator. So, we distribute consumer financial products online. We've been doing that since 2012. And over the last 10 years or so, we've served almost 1.5 million Malaysians for all kinds of financial services, be it loans, credit cards, deposits, insurance, and even wealth products. Lately, Jernexu has gone deeper into FinTech beyond just comparison, aggregation, and application for financial services products. We're also helping the next layer down in terms of helping financial institutions, whether it be banks, lenders, insurance companies, acquire the next set of users digitally and non-digitally, as well as assess them, risk assess them to make sure that they can access more, they can actually reach more people with better products. So in terms of Finclusion, We are heavily involved in the digital banking space in Malaysia. We've been announced as one of the consortium partners, as a vendor partner to one of the digital banking consortiums here in Malaysia. But we're also working with a couple of other digital banks on enabling them to access, their next 100,000, 200,000 million customers here in Malaysia through better onboarding and credit scoring.
Thanks, Han. Now, Southeast Asia has come a long way in the last decade and is now home to about 440 million digital natives. 8 out of 10 of them are actually transacting online ever since COVID. Yet over 6 in 10 Southeast Asians today still remain relatively underbanked or unbanked. 60% of micro and SMEs here are unable to get a loan when they need financing. So that brings us to today's topic of financial inclusion, right? Informal workers in this part of the region makes up about 70% of the workforce. Many still remain underserved. About 60% of the people here still prefers to transact in cash, which is very difficult to get them any sort of credit scoring or to get them loans if they need one. And we have 2 InsurTech here today. InsurTech in the region is at about 3.4%, and in Malaysia at about 5.5%, way lower than the global average of about 7.4%. So with this, maybe let's kick things off with the first question for Wilson. What do you think are some of the historical barriers that have prevented financial service from achieving its broader penetration here, both in Malaysia and Southeast Asia? And what do you think is the most critical financial services needed for this region?
I think it is safe to say that Southeast Asia is the most exciting region to do business in this era. We have a 650 million population and a 3 trillion GDP. And FinTech companies, InsurTech companies are flourishing in many parts, in different markets in this region. However, if you were to learn about what are the stumbling blocks or obstacles that prevent more businesses to truly streamline the businesses regionally, I believe we can take a page out of the incumbent financial services. And drawing my experience as a former banker working in a universal ASEAN bank, I believe that there are 2 main blockages that prevent regional companies to truly be a regional player in a universal market like Southeast Asia. Number 1, it would really be the infrastructure. Because yes, Southeast Asia is one ASEAN alliance. However, infrastructure in the respective markets, they are so different. However, we are starting to see that there is a concerted effort by different regulators in the market, in the region, who are trying to bring together the standardization of infrastructure. And let me give you an example. For example, Bank Negara Malaysia, with PayNet, they are already working with BOT in Thailand, with the counterpart in Singapore, PayNow, to enable cross-border QR payment. And what does it mean? In the near future, when you go to Thailand or you go to Singapore, using your wallet, and you scan a QR code at the merchant and the local merchant, you are able to transact seamlessly. And this, to me, is one of the important steps to ensure that infrastructure in different markets are able to be streamlined, standardized to spur further regionalizations for businesses. And this has been one of the key stumbling blocks in the past, but of course, now there have been a lot of initiatives being taken place. And this is one key example. The second obstacle or challenge would be really about the regulations. Different markets, there are different regulations. And when I mention regulations, it's not just about financial services regulation. I'm also referring to regulation when it comes to setting up a new business in a new foreign market, having a fully owned subsidiary or a fully owned entity in a different market, because different market, they have their different interests, right? And this is where I think it's very important for regional tech companies to understand regulation deeply and to understand what kind of licenses and also opportunities one could leverage on to spur further regionalization growth. And I could share from PolicyStreet's perspective. So we recently grew to be a regional reinsurer and also an offshore general insurer. We obtained a license from Labuan Financial Services Authority, which is part of the entire regulation emblem under Bank Negara Malaysia as well. Being a regional reinsurer, it allows us as an InsurTech to seamlessly grow to different regions without the need to have an onshore license. And that is a business model that has been practiced by many other global reinsurers in the past. And this is where I believe if tech companies, fintech companies, startups are able to really understand the insights of regulation, the obstacles of having regional penetration can be solved in a very effective manner.
Thanks. I think a lot of us here who came in from Singapore and Thailand is looking forward to the real-time payments cross-border-wise. And my next question is for Sheyantha. Congrats on winning one of the 5 consortiums for the digital banking license. And Boost has already been one of the leading e-wallet players solving many of the financial inclusion problems for Malaysia. How is getting the digital banking license going to change the game for you guys?
Okay, maybe before I get into the digital bank itself, maybe I'll talk a bit about what you said about how we started off as an e-wallet player and the evolution we've had over the last 5 years. I think when we started this journey back in, I think it was around 2016, 2017, the landscape was quite different. So there weren't QR code payments here in Malaysia. There were skepticism about the fact whether the China-based model, which is really what kind of started in mainland China, right, using QR code payments as a mainstream payment method would take off in our markets, right? So, and when we started that journey 5 years ago, I think there was a realization that something like payments would never be an end in itself, but it would be more a means to an end. Right, so if you think about the early playbook that we had payments or the e-wallet license, which was really one of the few licenses that were available at the time, as a beachhead to get into a larger play. And we had the choice at that point, especially starting off in a market like Malaysia. We got into Indonesia as well. Where do you play in this sector, right? So Malaysia is a market that is, upper middle income. The general perception is that there isn't a lot of underserved segments, but if you really peel the onion, you do find that there are vast sorts of underserved segments that you can actually go into. So we decided very early on that yes, we would serve everybody, but with a particular focus on, when it came to payments, on sectors that were not served. So, your nasi kanda outlets, your food stalls, trying to get that element of the potential customer base cashless. That was a bit of a grind, to be honest, because you're trying to promote digital back in 2017-18 to a segment that is not very digitally literate. But in the end, I think, thinking back, that was one of the best decisions we made, because that then set the foundation for everything to follow, including the lending business that we launched. So in Malaysia, we are still known as a e-wallet, but actually our largest business is actually on the financing side, on the lending side. And that created a natural progression for us to think about banking and thinking about what we wanted to do in a banking environment, especially when the licensing framework came out. So we look at it almost as a continuum from where we started to actually getting the banking license. And I think that was, and it's part of kind of the realizing the playbook that we had almost 5 years ago. So I think in terms of what we want to do, I mean, if you think about us as a fintech player, we are servicing segments that are not generally unserved or underserved, focused significantly on micro SMEs. Looking at, we've always used the transaction data, which is kind of the bedrock of the first relationship we establish, to then do AI-based lending, all right? And that's what we've done here in Malaysia and Indonesia as well. So we've done about 1 billion ringgit worth of loans to underserved sectors here in Malaysia. Now, what the digital bank license does, I guess, is it provides us a construct and a mechanism to scale that model. Because I guess the dilemma we always had, or the dilemma we had about, when we were about 2 years or 3 years down this journey is this a model? If you stay as a fintech player with a compartmentalized license, or if you stay on the periphery, can you operate at scale? Given the fact that there's also a convergence with banks now getting more digital and getting into the fintech space, and how do fintechs then stay relevant and stay ahead and operate at scale? So I think our view is that and that was a little bit of the thesis why we decided to go into banking, because we felt that that was the next evolution, and it helps us to operate at scale. Now, when you think about banking, obviously, the big thing that a banking license gives you is it gives you the ability to leverage your loan book, because you can raise deposits, right? And that, but having said that, deposits is also a very crowded space. So you need to have a strategy around that. The other thing is, when you look at that, you need to always trade it off against the cost of the added regulation. So you get an advantage in terms of your ability to scale, because it opens up more doors for you. It opens up avenues. It opens up a regulatory environment you're operating in now that people trust because you're a bank, let's say. But at the same time, you need to weigh that against some trade-offs that you give up in terms of agility, in terms of cost of regulation and all that. And so net, when we looked at the regulation that came out here in Malaysia, we felt that the cost benefit kind of was in our favor, was in the favor of any applicant that had a serious model. So that's how we looked at it. So basically, when we to go back to your question, does it really change what we do fundamentally? I would say no. It accelerates the path that we had set ourselves on 5 years ago. Our model in terms of really, if you think about providing credit to underserved segments, small businesses, micro businesses, I think that would continue, right? We would look to leverage on the ecosystem of merchant base. We have about 500,000 merchants here in Malaysia. Most of those are the lower tier segments. Very strong in parts of Malaysia, like East Malaysia, Sabah, Sarawak. We're very strong in those parts. Looking to really double down on that. So that's a little bit what the license would do now. Obviously, we don't want to wait until we officially, launch. There's a lot of things we can do in the meantime, which we're doing anyway. So by the time we do launch, we look at it as an extension, a continuation of the customer relationships we have built, as opposed to a fresh new start.
Just double-clicking on that, how would that be different from the digital spin-offs from already licensed banks? And you mentioned that you focus a lot on the underserved, the micro SMEs. Is that going to be the key differentiating factor for you guys?
It depends, right? It depends on the model. So you're right. In some markets, there haven't been separate licensing schemes. So what banks have done is they've done kind of digital offshoots, right? And that's not something new. That's been going on for the last 15 years, leveraging an existing banking license. I think, again, it depends, right? So a lot of the banks, especially let's say what's been happening in Indonesia, has largely been, leveraging a traditional bank license to go into a new segment and doing a digital challenger bank under a traditional licensing, under a traditional license, right? I think a lot of the ones that I've seen, even traditional banks doing digital offshoots, is really to capture new segments as opposed to obviously competing with what they have. Right, so I think generally speaking, the strategy, even if you look at a conventional bank operating under a digital offshoot, has been to increase the size of the pie. So I would say definitely that model is something that is again about reaching new segments, new markets. I think that it's driven by twofold, right? I think one is the fact that traditional banks have realized that there are limitations to which they can completely digitize and be agile in their current setup because of things like legacy tech infrastructure, core banking systems, just the ways of working, right? And I think that's why the digital offshoot model has gained more traction and become more popular. Early days still, it's difficult to say which model wins. It also, if you are a traditional bank, I think if you're coming from the banking world, you really need to weigh the trade-offs of whether you want to apply for another license or whether you just leverage your existing license. I think most banks have taken, some banks like Standard Chartered have gone for different licenses in countries like Hong Kong. In other markets, they've leveraged their existing license. So I think it's that depends on individual circumstances for each FI. But generally speaking, I would say most of the offshoots that I've seen are really to really tap new segments as well.
Thanks. And maybe Han, I think similar question for you. Congrats, Jinexu is also one of the winners as part of the KAF consortium. And earlier you mentioned a little bit about that, but could you elaborate more on the approach that Jinexu is taking and kind of the role that it's going to play in the consortium as well?
Sure. Thanks, Josh. Yeah, I think, yeah, so it's been widely reported, I guess, that we are part of one of the consortiums. You mentioned CAF. But what is less reported is actually we're also supporting several other current and incoming digital banks with their operationalization and setup, right? And why are we doing that? Because, I mean, historically and at our core, you know, we started off as a financial product aggregator, right? And through that, we've learned quite a lot of things around distribution of financial products, consumer financial products to Malaysians, right? And that brings itself certain competencies when it comes to acquiring customers, engaging with them, making sure they're well educated, making sure they know what they're getting into, and making sure you can do that effectively and at commercial scale, right? So we can bring those kind of competencies to any, not just digital bank, but any kind of digital financial services provider. And we've chosen to do that across the industry, the same what we were doing with Ringgit Plus over the last 10 years, you know, bringing the capability to engage and acquire customers for banks. And we've been working with banks for the last 10 years. So we're going to do that with digital banks as well. And the other core part about what we can do and what we're doing today to enable better financial inclusions through working with digital banks is that we see a core problem from working with existing banks, traditional banks over the last 10 years to distribute products such as credit cards and loans, right? We see the core problem being ultimately split into three. The first being process. Do banks have a good process to access, you know, their next set of customers who may not be where they were walking into branches, having passbooks, things like that. The second problem being, other than process, is policy. Do we have the right policies to cater for this new audience, right, who may not have a full-time 9-to-5 job with salary coming in monthly? They may have, you know, weekly inputs from, you know, their ride-hailing platform coming in. How do you have a policy which can credit score those people, do KYC on these people, do a full CDD, customer due diligence on these people, to enable yourself to offer them the right product for them? And the final part, and I guess most important part, that is stopping current banks from being able to compete in the next 10 years is going to be profitability. Why I say that, I mean, Sheyantha touched on it in terms of legacy, right? But how this actually translates itself into reality for banks and consumers is far more expensive products when it comes to lending. What do I mean by expensive? Higher rates than they need to be. And far more expensive products when it comes to deposits. What do I mean by that? Far lower rates for deposits than they need to be. Why? Because, you know, there is something called a cost-income ratio at banks, which is a certain size, which they can't do anything about. But a digital bank can do something about it, and we can certainly help a digital bank do that, right? To reduce that kind of cost-income gap, which then brings true inclusion. Why do I say that? If it's not profitable for a bank to service its customer with a product, they're not going to do it, and therefore that customer segment is going to be underserved or not served at all. But if we can reduce the entire we can reduce the entire hurdle rate for a bank to actually access a customer or offer a product to a customer, that by nature brings in a whole new set of customers, right? If you can make it a profitable enterprise for a bank to do so, they will do so. Banks are not charities, right? So that's what we do. We hope to do with the consortium we're in, along with, you know, a couple of the other consortiums which are starting out in the next 12 to 24 months, is to ensure that they can meet the thresholds for this policy, process, and profitability metrics to then offer true inclusion products, which is products which are priced in a way that is profitable for the bank, yet can reach a whole new segment that they could not before.
Thanks. And we've covered a bit about how kind of the digital banks can help with financial inclusion. Maybe Han, what do you think regulators can do more on this space?
I love questions about regulators. Junexu, we are a regulated entity. We've been previously regulated. We are currently regulated by Bank Negara as an insurance and Takaful aggregator within that sandbox license, as well as the SC for a separate license in financial planning. So we've been working with regulators over the last kind of 8, 9, 10 years. We have a good sense of regulators here in Malaysia, how they behave. And for me, what we've seen time and time again from pretty much every single market is a two-pronged approach for a regulator, right? And one is, a large gate, right, which stops new entrants from coming in. Why? Because there may be systemic risk from risky new entrants coming in, serving a customer in a way which has not been served. There is a reason why regulators exist, right? It exists to protect, the overall system, the overall financial system, be it in the banking, insurance, or wealth industries. And we're seeing not so heavy supervision on entities which come in because there's been a large gate. So the way I see things going forward in the next 10 years and how regulators can maybe pivot slightly to further encourage innovation, which can reduce those three things that stop inclusion, is perhaps a smaller gate, but more focused and more regular supervision. So you let innovators in, but you watch them more closely, rather than the opposite, which is you make it difficult for innovators to come in, but then once they come in, you go, well, we vetted them, so they should be fine. It should really be the opposite, which is we'll let as many people come in as we can assess practically, but we will invest quite a lot more in making sure we keep an eye on them, not just to keep an eye on them and supervise them, but also to keep an eye on how they're developing the market, so that we ourselves as regulators can upskill ourselves in terms of, hey, these fintechs are coming in, we'll allow them to do certain things, we'll let them do it more easily than we have done it before, but we'll keep a closer eye on them than we are currently doing, right? Because that's the model that works for regulators, encouraging innovation, to make sure that innovation can be done freely, but also monitored for safety.
Thanks. And over to you, maybe Wilson. You work with many fintechs as part of the FinTech Association and as a regulated insurer tech as well. What do you think are some of the pitfalls when it comes to driving financial inclusions or challenges that you witness over the last couple of years? And how do kind of new entrants or existing players avoid these pitfalls?
Sure. I'll give my perspective more on the insurance vertical, since my fellow panelists have covered mostly in banking. Yeah. And insurance is one important component in the entire financial services. I think, first of all, one must get the definition of Finclusion or financial inclusion right. I think at this era, financial inclusion is not exclusive for the B40 or the B50. Today, we are undergoing through the stagflation period, whereby even the middle class is facing compression of margin, a reduction of disposable income. And I believe Finclusion is also very much relevant to the middle class. There are certain stumbling blocks which we see facing in the insurance industry when it comes to advancing financial inclusion. And this is mainly driven through three factors. The first is the incumbents, most of the existing players. They are designed and built to cover a certain segment of the customer base. And they have been working on it effectively in that manner, and it's not to their best interest to expand to a certain segment that may not be effectively served by the incumbents. And this is where we have fintech companies. We have tech challengers. And number two, I believe in the scope of insurance, most of the time insurance products are complicated. And they are not simple. And third, which I believe is the biggest factor, the most important factor, is that insurance protection may not be relevant and meaningful to the segment that is being served. And this is where I believe in order to advance a meaningful financial inclusion for the bottom 40, for the emerging affluent, for the middle class, which is the most important backbone for the economy in Southeast Asia, fintech companies and insurtech companies have to provide simple and meaningful solution. And this is also the vision for PolicyStreet as an insurtech challenger. We work with different underwriters, and we ourselves also develop our own insurance products to serve the gig workers, for example. So today, there are more than 200,000 gig workers on the road in Kuala Lumpur and most part of the cities delivering food. And today, what we have done is to curate and develop a micro-insurance that can be meaningful enough for the livelihood for these gig workers. So they are protected not just on merely death or total permanent disablement, but what is important is also on daily hospital income. For example, gig workers, they get into an accident. They are not able to work for the next 20 days. And most of these gig workers, they rely to draw incentive on the day-to-day basis to put food on the table. And what PolicyStreet has done is to develop a daily hospital income scheme to ensure that these gig workers, if they fall sick, if they get into accident, they are able to draw certain coverage on a daily basis. So at the very least, if they are not able to deliver a parcel from door to door, they still are able to tap into some pool of fund to sustain the family. And this, to me, is the relevance of financial inclusion, is the power of InsurTech solutions. Because all in all, financial inclusion has to be done in a meaningful and a relevant manner. And of course, it is also very much subject back to really understanding your core segment and what kind of right products are able to be curated for them. It's not just about pushing for products because there are many complications and factors to be considered. So this, to me, is a big equation for financial inclusion.
Thank you. I guess in the last 1 to 2 minutes, maybe some closing thoughts that everyone can provide. Where do you feel you want to see the Malaysian and more broadly the Southeast Asian fintech ecosystem in the next 5 years? Maybe spend 30 seconds covering your thoughts. Starting with Sheyantha.
Sure. I think it's going to be driven by two things. I think we spoke about regulation. We spoke about, I think, also we need to look at what investors are looking at. I think it's been very clear that going forward, a lot of investors are looking to back models that are sustainable. And whether that means profitability or some other form of sustainability, the devil is in the details. But I think the fintechs that can scale, serving underserved sectors or fintechs that have a model that is sustainable, I think that's one. I think the second thing is the way regulation is evolving is also going to be critical in Southeast Asia and South Asia, in Malaysia. I think it's very clear that regulation is evolving to enable fintech players to come in into the mainstream. But at the same time, regulators have realized that as fintechs grow, there is systemic risk, right? So how do we bring them into a fold in a sustainable manner? I think some of the licensing schemes, different regulators are taking different approaches, but I think some of the licensing schemes are done particularly with that intention. So I see a lot of that kind of unfolding. I see a lot of fintechs really doubling down on a few models. There was a lot of experimentation that happened in the last 5 years. I think a few models are going to now converge and come out very clear. And I think also the regulatory landscape is going to evolve in such a way to enable a few of those models to succeed.
Wilson?
Well, in the interest of time, I'll just keep it short and sweet. I hope to see in the next 5 years, there will be a lot more successful fintech companies in Southeast Asia. Fintech companies which can get listed, which get to exit, which get to merge into even larger conglomerates to provide real meaningful solutions to the market in Southeast Asia, and to really position Southeast Asia as the preferred go-to destinations in the world. And it's not just exclusive for some of the larger markets in the US, in China, and the European markets. And this is what I aspire to see in the next 5 years for Southeast Asia.
Thank you.
Oh, tough one. 30 seconds. Okay. I think that one thing that most people forget is that banks were one of the first tech companies, actually, right? Funny story is that my mother was a computer analyst in one of the local banks here in the late 70s, early 80s, and they were using systems which nobody else was even using, right? So I would like to see, personally, in the next 5 years, for fintech to not be a thing, right? They'll just be banks, insurers, wealth companies, payment service providers, right? And they all use technology in the most kind of innovative way, right? So you don't really have to go, you're a fintech, you're a bank. No, these are businesses of which technology is a very, very big component of it, right? Or the component that matters, right? So that's what I hope to see, which is we stop doing this, oh, you're a fintech, you're a bank. Actually, you're all banks, you're all fintechs, you're the same.
Thanks, that's a very interesting insight to end off with. Thanks everyone for joining us. Thanks Han, thanks Wilson, thanks Sheyantha.
And thank you, Joshua.